strategy and how you can build your own trading strategy to conquer the markets. Now, there are probably as many trading strategies as there are traders, but not all trading strategies and trading plans are created equal. I suggest that you find some and then build a trading plan around them. There's a plethora of trading strategies available to you, but I encourage you to create your own. Now, that doesn't mean you have to start from scratch. You can take a well-known strategy, you can take some guru strategy, you can take something you've read about on the internet that you like, but don't follow it blindly. Turn it and make it your own. When you build and test your own strategy, you are the master and you understand all the ins and outs. You're not just trying to duplicate someone else's thoughts, because it's virtually impossible for me to take any of my setups or my tradings and teach them to you entirely. I can't give you all the nuances. It's in the back of my head. I'd end up writing a novel, because I have different thought patterns for using that strategy in different markets when different things are happening. And you need to have those nuances in your head. And even though I would like to share them with you, and so would most of the group, it would end up making a novel that's hundreds and hundreds of pages long that you just wouldn't digest. But when you take a strategy and add a little bit of yourself, take away a little bit that you don't like, maybe adjust a little, and it becomes yours, you end up with all those characteristics and nuances, and you understand them. Now, I always encourage traders to develop their own trading strategy. There are several reasons why I believe it's important for traders to develop their own. First of all, creating strategy requires a trader to develop a greater knowledge of the markets and of the price movement. When you start building something that's unique and your own, you start paying more attention. It's like when it's the difference. Remember when your mom or your dad or your brother taught you how to drive? Well, when you're in the car and you're doing everything step by step and you're uneasy, but you're being really careful, and you keep telling you want them out of the car, you want to try it on your own, you know how to do it. Well, you'll eventually know how to do it. And I remember when I was 16, I'm 16 and a half, and I was driving already. And I had been working since I was 13. So I convinced my father to let me buy an Oval GT, a little sports car. My father was a good guy. He signed the paperwork. I was working. I had to make the payments and pay the insurance. But little did I realize when I bought the car that it was stick shift. It wasn't an automatic. And granted, I started driving in the 60s. Most people knew how to drive sticks. Automatics were fairly new, but I learned how to drive on an automatic. So I pick up the car after school, and I have to go to work. The salesman is bewildered. He doesn't know what to do. So he says, you know what, I'll take you in the back lot, and I'm going to show you real quick how to drive a stick shift, because I can't take the car back. I can't give you your other car, because once your father signed all the paperwork and everything, whatever. So he took me in the back lot, and for a half hour, 40 minutes, he showed me how to drive a stick shift. Well, I know this story's getting long. Well, I was able to get it in the first gear and second gear, and I kept stalling it out, but I was all right, and work wasn't that far away. So once I got down to the lot and got on the main street, and remember in the 60s, things didn't move that fast, and I wasn't going on a highway. I was just going like 6 blocks down straight street and turning left. Well, I never got down to second gear, and I got to work. Well, I worked till 11 o'clock, and by then, the sidewalks had rolled up. There was nobody out. And I decided to take the car for a spin because I was going to master this stick shift. Well, that's till I got to a street called Rolling Road. And I know this is a long story. Well, Rolling Road is exactly what it is. It rolls up and down, up and down, up and down. Well, I'm playing with me, shifting my gears, trying to get up the hill. I get up the hill, I get to the top, I come down. But then I get to the next one, and there's a light at the top. Whoa. Now I don't know how to stop the car. I know how to put the brake on top, but I don't know how to shift the gears and get it going when I'm, not on flat surface. Well, I eventually figured it out. But, in 2 or 3 days, I'm able to shift that car on the highways. I can feel it. I'm not even looking at my hands. I'm not thinking about the clutch. Bing, 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 bing. It's all coming naturally because I've learned it and I mastered it. And this is the same thing about assets and charts and a price action and strategies. When you can master it and you can feel it and you understand its characteristic and you get to shift those gears, it's yours. And you can make much smarter decisions because you learn the ins and outs and you've added your own twists. Now, this can be a time consuming thing. Okay. I happen to enjoy it. I still am constantly defining and refining, coming up with new setups, new strategies, new everything. But how I generate it is by watching charts. What I look for and why I look to build a new strategy, and not necessarily all from scratch, but I look for a trading opportunity that I missed. Not because I didn't look at it, that my indicators, my strategy never picked it up. And I said, okay, what could I have adapted? What could I have done? What indicators, what pieces of information could I have assembled that would have picked out that opportunity that I missed? Because missing an opportunity isn't like losing money. It's just, the markets give you tons of opportunities. And from there, I start building something or adjusting something I have to add in things that I wouldn't miss that opportunity the next time. So in short, you want to analyze your charts looking for opportunities. Examine those opportunities and construct how you turn those opportunities into real money. And of course, you also want to know how to turn into real money without exposing yourself to risk. So once you've gone through several opportunities in fashion, you will be well on your way to creating a profitable trading strategy. Now we want to see if that strategy worked, not just for that one missed opportunity. The reason Legacy, as well as most brands, give you an ongoing demo platform is because that's exactly what it's there. It's for to test strategies, to define strategies, and to trade risk-free, or not to trade, but to trade risk-free, to try out and adjust everything. Okay, because a lot of times you'll put a strategy down and it'll work, and it'll say, "Look, I missed it. Look at it. Pick this one up," but you'll find in the long run it doesn't, or in the long run it's got more losing trades than winning trades, or it's not really covering your risk. And so it's not worth having. And this is why you would use a demo. And you try it out many, many, many times and many different assets in the class of assets you trade to make sure that it works. Now, remember, not all trading advice is good advice. Figure out where the advice comes from and how much you can trust the source. This is particularly important when using the internet. There's lots of amateurs out there who think they know what they're doing but don't. But you can go out there. There's lots of people, lots of teachers, lots of educators, lots of traders, lots of gurus who have all types of strategies they've come up with on the internet. They've got YouTube videos, they've got internets, they've got ebooks. Don't go buy something. Okay. Don't get in some, and don't get somebody who says, use this scanner, when this scanner does that and that, trade that. Okay. Use somebody's trading strategy and then adjust it, test it, and modify it. Okay. But you don't have to reinvent the wheel. Now, the question is, do you want to use technical analysis or do you want to use fundamental analysis? And what do you want your trading strategy to accomplish? Okay. Because you can't have one strategy for everything. You can have one trading plan that covers everything you do, but a strategy is a set of filters. It's an input and filter system. Now, you have to decide what you want it to accomplish. Do you want it to give you buy and sell signals? Do you want to give it your entry points? Do you want for it to tell you when an asset's overbought or oversold, or when you should exit the market? Okay. So you can have one strategy for finding buy and sell alerts and buy and sell signals. You can have a completely different strategy or a different set of inputs for determining what price you would actually enter that trade. So online trading is considered by some to be one of the most challenging styles of trading, which is why it's important to jumpstart your journey with proven strategies. Success in trading requires constant technical precision, emotional restraint, and mental focus. So, number one, building your strategy. You want to think differently. You want to create a strategy that's unique to you and that's not the same three things the whole world is doing. Now, again, we're not going to go out and say, okay, I'm going to use MACD on a 7 and 17 and a 92, and I'm going to use moving average crossovers using a 47. No, no, no. We're not thinking differently means maybe I won't use RSI and stochastics. I'll use maybe MACD and I'll find a different indicator. Or maybe, like right now I've added in displaced moving averages. I love displaced moving averages. Okay. Because trading is simple, but it's not easy. That's where effective trading strategies are vital. The reason it is not easy is because it's an ongoing exercise in psychology, and invariably we get in our own way. To correct this, we must recognize how we have programmed to think, then begin to think differently. So we want to have a strategy that doesn't have any of our psychological phenomena in there. We want to have a strategy that doesn't leave us open to emotion, doesn't leave us open to, oh, look at that, it's a perfect setup, I'm going to make a trade. And we want to think differently and we want to plan. So the best way to rein in emotion is to have a trading plan to read and read it daily. Okay, our plan is not our strategy. Our plan is our overall practice of trading the markets. Okay? It's our Bible of how we're going to trade. And it's important for us as traders to refresh these criteria in our minds before trading. A solid trading plan enforces these points, and by reading our plan, we recognize the importance and begin applying them. When this occurs, we have started down the path of focused and disciplined trading. So our trading plan keeps us on a disciplined track. Our strategy tells us how we will use or make, like I said, I have one strategy that gives me buy and sell alerts. I have another strategy that will give me entry points. Okay. So I need some type of strategy because otherwise I could spend all day looking around at thousands of currency pairs. Or I could have a very specific thing that's on my charts that will say, here's a buy opportunity, here's a sell opportunity. That's just opportunities. Then I have to apply another strategy and another set of thinking, saying, okay, is that a really good buy opportunity? Is it a high probability trade? Then I said, okay, I've got a trade alert. I got a buy alert. I then have a strategy that tells me, okay, yes, I filtered all this out and it is a good buy situation. I have a third one that tells me the price I want to enter at or when I'm going to enter the market. And then lastly, I have an exit strategy of how I'm going to exit the market with different criteria, what could happen. Now, continued education is one of the most important things to a trader. Whether you're an experienced trader or a novice, I'm constantly learning, like displaced moving averages. It's been around for several years, but it really hasn't been talked about too much. And in the last 2 years, because of the new kind of charts we have, it's been becoming, we can use Java and HTML charts that we can adjust indicators that we couldn't adjust before. That I've really started developing this liking for displaced moving averages. Now, if I hadn't been studying the markets and learning and listening to what other, going to webinars and seminars and constantly educating, I would have never even seen, because displaced moving averages isn't something I came up with. So it's like when we were in elementary school, we learned our ABCs and our one, two, threes. As our education evolved, we used these to build sentences and solve math problems. And the further our education expanded, the more proficient we became. Because of our continuing education, we developed the ability to write pages of sentences and solve quadratic equations. Developing our trading prowess is no different. We begin by learning the fundamentals, then progress forward. In doing so, our techniques and strategy become consistent as our results improve. Now, today, traders have all these modern computer methods of interpreting price and buying trends and seeing everything instantly. We have scanners, we have robots, we have AI, we have God knows how many indicators that we can adjust any which way we want on charts. We have beautiful colored charts. We have charts that'll talk to us. We have charts that'll notify us. We have charts that'll send us out alerts. So no matter how sophisticated they get, all traders must get back to the basics and simple trading to be successful in the long term. But remember, the strategy to enter the markets is only the beginning point. Because you know what? Until you've actually entered a trade, you're not in the game. So the strategy, your basic strategy gives you an alert, a strategy gives you entry, it's just getting you in the game. But once you open a trade, that's when you entered the risk and you entered the game. You need to have a strategy that will give you exit points or how to handle an asset if it isn't doing what you thought, or if it's doing exactly what you thought, but doing better. So where do I start? Okay. There are three things I put together for every chart and for every piece of information. And no trader should, I don't use the proper English. Every trader should at all times have their support and resistance levels on charts, because these are probably the most important informational lines you can possibly have. Now, in today's class, we're not going to learn in any great degree about support and resistance because we have whole 1 hour classes in just understanding of it. But remember, support and resistance are the stories of the ladder, the steps in prices. Price climbed up the ladder, climbed down the ladder, climbed up the ladder, went down the ladder yesterday, went up the ladder tomorrow, went down the ladder last month, went up on the roof to paint the ladder, the last year, up and down, and where the steps were in this ongoing journey. So if you think of support and resistance, and I like to take this word support and resistance, throw them in the trash can. They get a little bit, oh, what's the word I want to, they get a little bit confusing. This price goes up, price comes down, but the price level, so I call them price levels. This price level coming down here in a downtrend was resistance. But at this point, it was support. So if you call them price levels, they are the steps on the ladder. Whether you were climbing up that ladder or down that ladder, you stepped on that step. So if you think of the price moving like an elevator, you have the floor below your feet, right? And that is supporting you at the moment. If you want to go up, you have a ceiling above your head. So we could call this resistance at the moment. When the elevator starts going up, what happens is you break through this ceiling and it now becomes the support under your feet and you have a new ceiling. When you turn around and you're coming back down, you still have the same floors, but that ceiling here, when you're coming down, is above your head, and it's that floor that is your resistance. You have to break through that floor. Once you do, it becomes the ceiling over your head, and the next floor becomes your support level or your resistance level because you have to break through it. But they're the same levels. It's the first floor, the second floor, the third floor. And Once you've analyzed it, know, okay, well, this building has private floors, 5 levels here, here, and here. So when I get on that elevator, it's not going to stop at this level. It's not going to stop at that level. The next level is going to be here. So this is our resistance, because most times that elevator will stop at that point. It will bounce off of there, might come down to the basement again, or it might go up to the next level. Don't care. All we know are these are the floors above our feet, above our head and below our feet. And it's the same floor when we're going down. It's just in the opposite direction. So we know we have to break through those. So they are significant price levels. And those price levels should be on our charts at all times. So if we look here at my live chart, so see, this is a resistance structure here. Now it becomes a support structure here. But this is the price level that is important to us. Okay. Now, in this case, we are predicting price to move up. So that would be the resistance. But do you really care what it's called? I just know that this price is the next one that's going to be in my way. Now, to build your strategy, let me get my marker off of here. It won't turn off. Give me a second. Okay, to build our strategy, we need these levels on our charts. Now, this sounds like it's a time-consuming, complicated process, but it really isn't. It is only the first time you have to do it. Because now, if you're look, this is my teaching chart here. This is the Euro US dollar 30-minute chart. Now, all these red, blue, gold, dashed, dotted lines are all my support and resistance or price levels. These didn't come from yesterday. I didn't draw them on this morning. Okay. These came from, sometimes they're 6 months old, sometimes they're a year old. Each time that the euro dollar passed through this time range, this price range, it stepped through these levels. Now, I've color coded. These are my own particular color legends. You can make them all of your own. But like my blue lines tell me that they're very, very old support and resistance lines that have held true for way more than 6 months. My gold lines tell me they are also important levels. So when you see solid and thick, and I will change the color code as they get older. Okay. You can keep adding on to more, because in the short term, we can see that this level, right about here, had some structural importance. Maybe this level had some importance to it. But these are very short-term levels. Okay. Because we got these longer-term levels by looking back on the chart over time. So you can see now, all of these levels, but they're there. Okay, because as price has gone up and down through this point of this price, or wherever it's traded in the past, wherever it has stepped on those ladder steps going up or down, I've drawn my lines across. So today I don't have to draw any more line, because they all just go forward into the future. And all of these prices are structurally important. And the longer they've held up, the more important they are. So I know as price is moving up into this blue level here, that price is going to be very, very important. And this zone between those two is going to be even more important. So my charts always have this on them. So it is one of the key pieces of information you need to have on your chart to build your strategy. Now, I use 3 pieces of information and 1 independent support, because the last thing I add onto my charts is always volume, because I confirm my decision by looking at volume, because volume should be increasing or decreasing depending on what is happening in the market. And if I see a opportunity or a breakout or a breakthrough, then I want to look at my volume to see if it confirms. So again, here's another significant opportunity. So here we've got our support and resistance levels. We're in a tight consolidation range, but we can see every time price has fallen to 22.92, it's bounced off. It's moved up here, come back down. Now we're waiting for it to break the 26.39 level and climb up that ladder to the next point. So this might give us a buy range or a trading range that we can think about seeing an opportunity. Now, my second key important piece of my strategy is when price breaks a key level, do I have a candlestick that supports the breakthrough? In other words, down here, we saw the price stuck at the 22.92 level. It bounced off of our price level here. And we then got two blue candles, but you see how we got this indecision candle, and then we got to follow it up by another green candle. Okay. If I'm looking for a breakthrough here to continue up for a strong buy opportunity to break out of here, I want a strong candle. That means a fairly large body candle with two equal sized wicks to confirm the breakout and the movement. So at this point, I would want to see RSI, which is down below, if I'm using an indicator, moving into a overbought or oversold area. I would like to see it supported by my support or resistance level, and I need a candle structure that confirms my opportunity. And then lastly, I'm a pattern recognition trader. I look for breakout patterns. I look primarily for triangles, whether they're ascending, descending, whether they're symmetrical, and I call a wedge a triangle, anything that's a triangular shape. So whether it's a pennant, whether it's a wedge, whether it's an expanding wedge, a contracting, whether it's an ascending, they're all candlesticks. And I'm looking for breakouts from those particular patterns. And together we can combine those into an easy to understand trading strategy. So I'm going to share with you a little presentation on looking for a trend with support and resistance and using it to make a trading decision.
So apart from helping us to identify potential trade areas, one of the other common uses for support and resistance is helping us identify whether a market is ranging or trending. If price is making higher highs and higher lows by breaking resistance levels and using them as support, then the market is said to be trending upwards. And if the market is making lower lows and lower highs by breaking support levels and using them as resistance, then it is said to be trending downwards. If the market is moving sideways between two levels of support and resistance, then the market is said to be ranging, as it is not making any significant movement to the upside or the downside. Some traders have strategies they will only employ if the market is trending or ranging, so using this analysis helps them to decide whether to implement a particular trading strategy or not. So why does support and resistance work? Put simply, support and resistance areas work because lots and lots of traders are watching them. Traders identify these areas because you tend to get a lot of trading activity at these levels. Some traders will be waiting to trade the reversal at the identified area, and other traders also like to trade the breakouts, whereby price breaks through the support or resistance area and the trader takes the trade in the direction of the break. So if price broke through a support zone, the breakout trader would sell the market in anticipation of the price falling further as it has broken through a support area. All of this increased trading activity usually results in either a victory for the buyers or the sellers, and because more traders are active at these levels, the reversal or breakout usually happens with some purpose and intent, which is what makes trading these opportunities so attractive to traders. However, it is worth mentioning, as with all forms of technical analysis, support and resistance is an art, not a science. There are going to be occasions where the market seems to forget that a support or resistance level is even there. It may just blast straight through it without even giving us an indication that any kind of reaction took place there at all. Or it may break a particular support or resistance area, and then reverse, having already broken the area. We call this a fake break, and it can trigger breakout traders into a losing trade. It can also frustrate reversal traders, as the signal for the reversal doesn't happen in the identified support and resistance area. What we as support and resistance traders have to do is have other mechanisms within our trading strategy to refine which opportunities we take at support and resistance levels, other than just identifying them and waiting for price to reach them. If trading was that easy, we would all be millionaires. So how should you use it? For me, support and resistance is a key part of my trading strategy, but I do not use it in isolation. I have other analytical techniques that I use and wait for to give me confluence before trading. If I were to trade solely using support and resistance, I wouldn't be profitable, and it's as simple as that. I personally think support and resistance works best when you use it as one of a few layers of technical analysis that make up your trading strategy. For example, you could use it as the foundation of a strategy and build on it with a few different types of dynamic support and resistance, like moving averages and Fibonacci levels. Or you can use it to build on a strategy where the foundation comes from something like Elliott wave theory and look for a particular candle pattern when both streams of analysis line up. Like with any successful trading strategy, you need to have more than one analytical method. If you have a few and all the analysis lines up for a particular trade, then this gives the trade confluence, as it has a number of factors telling you there is a good chance this trade will be a profitable one.
So there were two important points here. One is we talked about support and resistance and adding it to trading strategy. And then it's adding technical indicators and what we call confluence. Okay. Because support and resistance alone serves as information. It gets you somewhere, but it doesn't tell you what to do, because those levels can be broken. But we have to understand how we can build a trading strategy, and this is just one of the steps in this path. But most people are either pattern traders, pattern recognition traders, or price action traders, or they trade from technical indicators. You're not going to ignore price, but they don't use support and resistance. They don't use trend lines. They use indicators together to filter out and come up with a trade. And that's another way that you can build your trading strategy. So here I put together for you a trading strategy using 4 different indicators and confluence. And you can see how they will serve together to give you a good trading system, how to enter the markets, how to exit the markets, as well as how to set your risk.
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The moving average convergence divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of 2 exponential moving averages which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter-term moving average is above the longer-term moving average, this area of the indicator will show activity. When the shorter-term moving average is below the longer-term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market, and may use it as a signal to exit a trade. Indicator 3. Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of their time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4. Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5. Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. We can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the Super Trend Indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the Super Trend Indicator to change red here before taking the short trade. So now we have the confluence of four indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the Super Trend turning back to red.
That's one way you can build a trading strategy, by using just indicators. Now, as I said, I'm a price action trader. I trade patterns. So I always start out with my trend lines. Then I add my support and resistance levels. Then I look at the price action. I look for the price pattern and for breakouts. And finally, I look to volume to confirm. And that can be your entire trading strategy. It's as simple as that. Because in trading, a lot of people tend to overcomplicate simple concepts. Sure, some of the concepts in trading are not the sort of thing you would know intuitively, but many things are easy. You just have to know what you're looking for. Now, if you have any questions, if you want any guidance, if you want somebody to help you build your trading strategy, go to www.legacyfx.com, go over to their education center, or send them an email, or use their live chat button, and somebody will be glad to help you through all of this, get you a demo account open, and help you start building a strategy that you understand. So thank you very much for joining us. And again, thank you for supporting investing.com and Legacy FX. Have a great trading day now.